Xi Jinping's growth target will require major stimulus if the trade war escalates. As the world watches, China finds itself at a crucial crossroads. Balancing ambition and uncertainty, President Xi Jinping has made it clear that China will not back down from its bold economic growth target this year. Despite the deepening trade tensions with the United States, however, if Donald Trump continues to hike tariffs, Beijing may be left with no choice but to unleash a powerful wave of stimulus to keep its economic engine running. At China's annual parliamentary session, officials reaffirmed a 5% growth target for 2025, marking the first time in over a decade that the country has set the same goal for 3 consecutive years. This decision sent a strong signal to the world. Beijing is determined to stay on course. But it also raised expectations that, sooner or later, the Chinese government would have to roll out additional stimulus measures to counteract the trade war's impact. A high-stakes game. China is not merely setting growth targets, it's backing them with action. The government has pledged its largest fiscal deficit in over 30 years and plans to ramp up local government bond issuance to record levels. These measures align with what markets have been anticipating, but more importantly, they reveal the leadership's growing sense of urgency. For the first time since Xi Jinping took power more than a decade ago, boosting domestic consumption has become a top priority in China's annual work report. This shift in focus underscores a harsh reality: the country can no longer rely solely on exports. Particularly when facing an adversary as unpredictable as Trump. The announcement of this ambitious growth goal came less than 24 hours after Trump slapped a fresh round of U.S. tariffs on Chinese goods, raising them to 20%. The timing was no coincidence, it was Beijing's way of showing that it would not be intimidated. However, with more tariff increases seemingly on the horizon, the real question is, how far is China willing to go to defend its growth? A balancing act between strength and stability. With tariffs threatening to erode one of its key growth drivers, China's leadership faces a tricky dilemma. On one hand, it wants to project strength and resilience to both its citizens and the global stage. On the other hand, it must avoid financial instability caused by excessive borrowing and reckless spending. Xi Jinping has long resisted the idea of large-scale stimulus packages, the kind of bazooka measures seen in past economic crises. Unlike during previous downturns, or the aggressive interventions of other major economies, Beijing has held back since the pandemic. But as Trump's tariff war escalates, the pressure to act is mounting. It all depends on how much they are willing to sacrifice for growth, said Christopher Bador, Deputy Director of China Research at Gabokal Dragonomics in Hong Kong. Officials could certainly ramp up fiscal stimulus, but the real question is whether they are prepared to stomach a significant rise in debt. The trade war gambit. While large-scale stimulus remains an option, another path for China is striking a deal with Trump. That, however, is easier said than done. Beijing could attempt to smooth things over by pledging to buy more U.S. goods or encouraging major Chinese companies, like EV giant BYD company, to set up factories in the United States. Trump, for his part, has expressed a willingness to talk to Xi, but no formal discussions have taken place since he returned to office. If Trump's proposed 60% tariff hike becomes reality, China's economic growth could take a major hit. According to Larry Hu, chief China economist at Macquarie Group, such tariffs could shave 2 percentage points off China's GDP this year. That kind of blow would be painful, but analysts agree that a well-timed stimulus package could soften the impact. Beijing's next moves. The National People's Congress, NPC, of China takes place from March 5 to 11, providing a crucial opportunity for policymakers to steer the country's economy. With deflation, a sluggish property market, and Trump doubling tariffs to 20%, Beijing has its work cut out. The stakes are high, not just for China, but for the global economy. Investors are watching closely, hoping to gauge whether new stimulus measures will be strong enough to offset the trade war's damage. The recent surge in Chinese tech stocks, fueled by excitement around AI startup DeepSeek, has injected some optimism into the market, but will it last? Nearly 3,000 delegates have gathered in Beijing's Great Hall of the People for the parliamentary session, where Premier Li Qiang opened proceedings with a work report outlining China's economic priorities. Among the key takeaways, the government is maintaining its 5% growth target for a third consecutive year, reinforcing its commitment to keeping the economy on track. Officials have hinted that more support could be on the way. There are indeed contingency plans for macroeconomic policies, said Shen Danyang, a key official involved in drafting the government's report. Policies will be dynamically adjusted to proactively respond to changing conditions. The next major economic update will come in mid-April, when China releases its first quarter GDP data. Shortly after, the Politburo will meet to assess the economy's trajectory and decide on further action. How big will the stimulus be? Analysts are divided over just how much China will need to inject to counteract trade losses. Carlos Casanova, a senior Asia economist at Union Bancaire Privée, estimates that filling the trade gap would require several trillion yuan. His estimate factors in China's ongoing efforts to stabilize its real estate sector and address local government debt issues. Other experts believe a smaller injection may suffice. Tommy Xie, head of Asia Macro Research at Overseas Chinese Banking Corp., suggests that a 1 to 2 trillion yuan $275 billion stimulus package could help China stay on track. Meanwhile, UBS Group's Wang Dao sees a broader fiscal deficit increase of over 2 trillion yuan as a possibility. However, if Trump's tariffs hit hard, Beijing may have no choice but to take bolder action, possibly even resorting to currency devaluation. A currency war on the horizon? During the first trade war in 2018-2019, China's yuan depreciated by 11.5% against the US dollar, offsetting roughly two-thirds of the tariff impact. Some analysts believe Beijing might use the same playbook again. China sets weakest yuan fixing since 2023 amid US tariff risks. In a telling move, the People's Bank of China, PBOC, recently lowered its daily yuan reference rate to its weakest level since late 2023. This suggests that China is preparing for potential currency depreciation if Trump follows through with his tariff threats. However, this time, the situation is more precarious. The yuan is already hovering at the lower end of its acceptable range, and further devaluation risks triggering capital flight. According to Guo of Hutong Research, if Trump pushes ahead with a 60% tariff hike, the PBOC may have no choice but to cut interest rates by at least 50 basis points and let the yuan fall past 7.3 per dollar. The calm before the storm? For now, Xi Jinping is maintaining a calm front, responding to Trump's escalating trade war with measured, moderate moves, but the reality is that this is a high-stakes battle, and if tariffs start causing serious damage to China's economy, all bets are off. Just hours after the new growth target was announced, the Chinese embassy in the US posted on X, "If war is what the United States wants, whether it be a tariff war, a trade war, or any other kind of war, we are ready to fight to the end." The message is clear: China is preparing for whatever comes next. And in a world where politics and economics are more intertwined than ever, the coming months could prove to be a defining moment in the ongoing power struggle between the world's two largest economies.